Good morning and welcome to the Shenkman Wealth Management Accountant Attorney Spring Webinar Series. This program is entitled U.S. Beneficiaries of Canadian Estates, U.S. Tax Issues Applicable to Inheriting Shares of Canadian Corporations. For those who don't know me, my name is Jonathan Shenkman, and I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. You can see all my work on my website at shenkmanwealth.com/articles or by following me on social media at Shenkman on Money. Additionally, I just launched my podcast, which is also called Shenkman on Money, and you can check that out on Apple Podcasts, Spotify, or wherever you get your podcasts. One more quick note before I introduce our esteemed speakers, and that is that the handouts to this program was sent out within the reminder email this morning. It will also be sent out again in the follow-up email tomorrow morning as well. Today, we're privileged to hear from Beatriz, Davila, and Sergei, Titorenko, both at firm MNP, which is a Montreal-based accounting firm. For my U.S. audience who may not be familiar, MNP was founded in 1958 and is one of the largest national accounting, tax, and business consulting firms in Canada. They have over 7,700 team members, over 1,100 partners, and work with clients around the world. Beatriz is a partner and business advisor with MNP's International Taxation Group in Montreal. Her services include cross-border international tax consulting, cross-border estate planning, and planning with trusts, personal tax compliance in Canada and the U.S., departure, and expatriation. Beatriz is a chartered professional accountant and chartered accountant. She also holds the U.S. Certified Public Accountant designation in Illinois. Sergei is a member of the Quebec Bar and is a cross-border tax practitioner. He provides tax and estate planning advice to high net worth families in Canada and the United States, including Americans living in Canada and Canadians moving to the United States, as well as business owners operating in both countries. As part of his practice, he also advises executors and trustees in the administration of estates and trusts with beneficiaries and assets in Canada and the United States. Today, Beatriz and Sergei will be speaking on U.S. beneficiaries of Canadian estates, U.S. tax issues applicable to inheriting shares of Canadian corporations. Now, with that introduction, I'll now turn the program over to Beatriz and Sergei.
Thank you, Jonathan, and good morning, everyone. In this presentation, we'll run through a case study to highlight the intricacies of Canadian taxation for Canadian estates with U.S. beneficiaries and the potential U.S. income tax pitfalls for the U.S. heirs. Just some housekeeping notes before we get started. This material is not comprehensive, as we will be providing a high-level discussion of select Canadian and U.S. tax issues. As you know, each situation of a Canadian estate with one or more U.S. beneficiaries is unique and may involve additional issues which are not referenced in this presentation. The analysis has been prepared based on current laws that are subject to change, and our presentation cannot be construed as providing tax advice. So let us introduce you to Dad's estate.
Good morning. So Dad was a Canadian citizen and resident. He passed away in 2021. At the time of his death, Dad was not married and did not have a common law spouse. Dad was not a U.S. taxpayer, nor was what we call a U.S. domiciliary for U.S. estate tax purposes. Among his assets, Dad owned shares of a Canadian private corporation, Canco. Canco is what is a PFIC or passive foreign investment corporation under U.S. income tax rules. We'll get into a bit later what is a PFIC. The beneficiaries of Dad's estate are his 3 children, namely 2 children who live in Canada and 1 child who lives in the United States, whom we refer to as U.S. beneficiary. All of the children are adults. Each child is entitled to a 1/3 share of dad's estate. The US beneficiary is not a Canadian tax resident as defined under the Canadian income tax rules. The Canadian resident beneficiaries are neither US taxpayers nor US domiciliaries for estate tax purposes. The three children are the executors of dad's estate. And finally, dad's estate is assumed to be an estate and not a trust under US income tax rules. We want to highlight one thing already, is that all references to US tax are limited to federal tax. We do not consider state tax in this presentation for the US resident beneficiary. And in certain instances, state income tax rules may produce different outcomes than federal income tax rules in the United States.
So in this case study, we'll go over 3 selected components. First, we'll do an overview of the Canadian tax consequences that arise on death of an individual and the Canadian taxation of the estate of that deceased individual. Then we'll do an overview of certain Canadian and US income tax compliance obligations, which may apply to the US beneficiary. And on our third component, we'll look at the Canadian and US income tax that may apply to US beneficiaries on certain transactions within the estate and on certain distributions from the estate. So let's get started. There are special Canadian tax rules that apply on death. When dad died, he was deemed to have sold all of his assets for proceeds equal to fair market value. There's some exceptions to these rules, but we're not going to cover this in this presentation. In that case, he owned the shares of Canco on death. If the fair market value of the shares on death was greater than the cost basis, a capital gain is realized on dad's death. That gain is then taxed on dad's final personal income tax return at graduated rates. In Canada, top rates on capital gains range from 24 to 27%, depending on the province of residence of that individual. Now, from an estate point of view, the estate will receive the shares of Canco with a cost basis equal to the fair market value at the time of dad's death. As you can see, the Canadian tax rules triggered on death from a for a Canadian tax resident differ significantly from the current US estate tax regime imposed on US citizens and domiciled individuals. By contrast, while the Canadian tax system taxes the accrued gains on the assets owned on death, the US system levies a tax on the fair market value of the asset, irrespective of gain or losses accrued on the assets. The tax residence of an estate in Canada is a question of fact. However, the Canada Revenue Agency takes the position that an estate resides where its real business is carried on, which is where the central management and control of the estate takes place, and that the residence of the executor does not always determine the residence of the estate. So usually the management and control of the estate rests with and exercised by an executor, a liquidator, an administrator, or other legal representatives of the estate. In our particular case, the Canadian tax resident executors make all the substantial decisions of the estate, in which case the estate is a resident of Canada for income tax purposes. And this will be our assumption for the rest of our presentation. So from a Canadian income tax perspective, the estate is taxed as an individual, but the rules for taxation of states and individuals are not necessarily identical. The estate of an individual during the first 36 months following the date of death of the individual could be considered a graduated rate estate, is what we call generally a GRE, if the executor so designates in the first year of the estate. In contrast, if we have a trust created in the will of the deceased, that is not a GRE. As the name indicates, a GRE has access to graduated rates available to individuals and a choice of year end. So now it means that the GRE can have a fiscal year end and not necessarily a calendar year end. So a GRE has a special status under the Canadian Income Tax Act, and this status is very important for tax and estate planning in Canada. In our particular case, we'll assume that the executors of that estate made a timely designation to treat the estate as a GRE.
So component 2 relates specifically to the US beneficiary. So we'll start with the shares of CanCo as under US income tax rules. So CanCo is in essence a PFIC, or passive foreign investment company, due to it being first a foreign corporation, and second, due to its assets and income being primarily passive in nature. Passive referring to income not derived from an active business, so it could be income from dividends, gains, interest, annuities, rental income, and other income of a similar nature. Under US income tax rules, as a beneficiary of dad's estate, the US beneficiary could be deemed to own 1/3 of the shares at CanCo as of the date of dad's death. And this could be with the beneficiary, this could even be the case even though the beneficiary has not yet received legal title to those shares and is not aware of that fact. So concretely, what does it mean to be a US shareholder of a PFIC in our case? Well, the US beneficiary will be subject first to a punitive tax on excess distributions. A distribution from CanCo is not limited to simply receiving or being deemed to receive a dividend. It can also refer to receiving property in kind or any item of a monetary value. An excess distribution is a very specific kind of distribution from a PFIC. It is one of two things. First, it can be a distribution whose value exceeds 125% of the distributions of the 3 preceding years, calculated as of when the US shareholder became a shareholder of that PFIC or is deemed to. So in this case, when the US beneficiary is deemed to have acquired shares of CanCo, i.e. date of dad's death. The second kind of excess distribution could be a gain realized on the sale of the shares of CanCo. And as we'll see, it doesn't necessarily have to be the US beneficiary owning the shares of CanCo who sells them, who realizes that excess distribution. It could also be triggered potentially if dad's estate sells the shares of CanCo or part of them without the US beneficiary even being aware. It should be noted that an excess distribution is punitively taxed under US income tax rules. First, the distribution is taxed as ordinary income, notwithstanding even if it's a capital gain, and it should be taxed at the highest US income tax rate, which today is 37%. On top of that, the beneficiary should be deemed to have received the distribution over a number of years, namely since the last distribution or acquiring the shares of the PFIC. And in each year, not only is a percentage of the distribution taxed at the highest rate, but there's an interest charge that is levied for preceding years as if the beneficiary had not reported the distribution. So it's effectively the beneficiary gets penalized. With respect to CanCo and with respect to the estate proper, the US beneficiary also has a series of US tax reporting obligations. And as we'll see, failure to comply with any of these obligations can trigger significant penalties. So the US beneficiary, even though he or she may not have yet received the shares of CanCo, still has to report deemed ownership of them and any distributions. And these obligations include first, Form 8621, which is to report if there have been any distributions received from the PFIC, and also to report if any elections are being made with respect to the PFIC. It should be noted that on a case-by-case basis, there may be certain strategies or elections that could be implemented to mitigate to a degree the punitive nature of PFIC taxation on excess distributions. But again, it's always going to be on a case-by-case basis, no size fits all. There is also an obligation to file Form 5471, which is to report first that the US beneficiary acquired the shares of CanCo or is deemed to have acquired as of dad's death, due to the beneficiary holding at least 10% of the shares of that company by either votes or value. And then there are two other obligations. There's Form 8938, and this is an obligation that many US taxpayers who have foreign investments may not be aware of, is that when you hold foreign, what are called specified foreign financial assets, so really foreign investments, which may include an interest in a foreign trust or estate, there's an obligation to disclose all of those assets to the IRS by filing Form 8938. If their total value exceeds a certain threshold, and that threshold will depend on whether you live in or outside the United States as a US taxpayer, and also on your filing status. If you're filing single or joint married filing, the threshold varies. Finally, Form 3520 is a form that must be filed to report any distribution that a US taxpayer receives from a foreign trust or a foreign estate. For all of these forms, there can be a significant penalty if there's a failure to file. In many cases, the base penalty could be $10,000 per form, although in certain cases, the penalty may even be higher. The US beneficiary as an executor also must file FBARs, or foreign bank account reports, to report their signing authority over any foreign or non-US bank accounts at dad's estate over which the beneficiary as an executor has signing authority. So we're now going to go to component 3.
So in this section, we'll discuss potential US and Canadian income tax that may apply to the US beneficiary on certain transactions within the estate and distributions from the estate. Within this section, we have selected 3 potential situations. Let's examine the first scenario where the state receives a distribution from CANCO, but does not make a distribution to the US beneficiary until a subsequent year. So on our initial assumption, we said that that estate was a GRE. The distribution received from CANCO will be taxed in the estate at graduated tax rates. For purposes of this discussion, let's assume a 40% tax rate. So as a simple example, and purely from a Canadian income tax perspective, let's assume that in year 1, CANCO distributes $100 to the estate. That $100 is not distributed or credited to a beneficiary in that same year. Now let's assume the estate pays the $40 of Canadian income tax on that distribution, and the after-tax amount of $60 is now capitalized in the estate and will form part of the estate capital. So in that first year, neither of the beneficiaries of the estate is subject to Canadian income or withholding tax on the $100 distribution from CANCO. Now assume in year 2, $20 is distributed to each of the beneficiaries. Again, solely from a Canadian income tax perspective, this amount represents capital and is not subject to additional tax to the Canadian resident beneficiaries, nor to the non-resident beneficiary. There are some exceptions as usual. So under Canadian income tax rules, there's a category of dividends that is called capital dividends, which can be received by Canadian tax residents on a tax-free basis. However, the distribution of capital dividends to a non-resident of Canada will attract Canadian withholding tax. We're not going to go into an in-depth discussion about the capital dividends, but this distinction will be relevant when we review the US tax implications for the US beneficiaries. So from a US income tax perspective, we have classified CANCO as a PFIC. Under the indirect ownership rules, the US beneficiary is treated as owning proportionately the PFIC stock directly held by dad's estate. In our previous example, the distribution from CANCO to the estate is treated as a distribution from the PFIC to the US beneficiary. The US beneficiary should be subject to US income tax on the distribution and potentially an additional interest charge. Even distributions from CANCO that are tax-free from a Canadian perspective, like the case of capital dividends, could be subject to these PFIC excess distribution rules. From a US income tax compliance perspective, the US beneficiary must report the distribution from the PFIC to the estate in Form 8621. Since the estate did not make an actual distribution to the U.S. beneficiary, Form 3520 should not be required under this scenario, as the income is only imputed under the U.S. anti-deferral rules.
So the second situation that we're going to look at is what happens if dad's estate pays distributions that it received from Titorenko to the U.S. beneficiary. So first, from a Canadian income tax perspective, at the level of dad's estate, in the year that dad's estate receives any distribution from Titorenko, the estate can allocate and pay that amount to the U.S. beneficiary or to any other beneficiary. By doing this, the estate is able to effectively deduct that distribution from its taxable income and transfer the liability to the beneficiary. The U.S. beneficiary should be subject to Canadian income tax on the distribution rather than the estate itself. Under Canadian income tax rules, regardless of what the distribution is, dad's estate generally must remit a certain percentage of the gross amount of the distribution to the CRA as withholding tax. The default withholding rate is 25%. However, under the Canada-US tax treaty, if the distribution is paid to a US resident beneficiary, it may be possible to reduce the withholding to 15% of the gross amount. Whatever the rate is, the estate is required to produce and file withholding slips called NR4s with the CRA, and to provide the US beneficiary, in our case, with a copy of the slip. For his part, the US beneficiary must report the distribution from the estate on Form 8621 and pay US income tax and potentially an additional interest charge. Fortunately, the Canadian withholding tax can be applied as a foreign tax credit, although it is not always a given that that tax credit may completely offset the US income tax liability on the distribution. In addition, because the distribution is paid by a foreign estate, the beneficiary should also file Form 3520 to report the distribution from the foreign estate. And I want to reiterate again, especially with the Form 3520, that a failure to file it can trigger a substantial penalty, and that penalty may even apply if it's filed but on a late basis. Now, the third select situation we're going to review is what if dad's estate transfers the shares of Titorenko to the US beneficiary? So I will discuss the Canadian income tax implications, and Beatriz will discuss the US income tax implications after. From a Canadian standpoint, this transfer of shares of Titorenko to the US beneficiary is likely to be deemed a distribution of capital by a Canadian estate to a non-resident beneficiary. And in this instance, the CRA has taken the position that this is as if the beneficiary disposed of their capital interest in the estate. And the reason we use the term capital interest is because, as we'd stated in the beginning, the estate, from a Canadian income tax perspective, is treated as a trust. And whenever a trust makes a capital distribution to a beneficiary, that distribution is generally treated as the beneficiary selling their interest, partial or total, in that trust. So the rule has been transposed to the estate. In this instance, the US beneficiary may be deemed to have disposed of a taxable Canadian property, or TCP, and may be subject to Canadian withholding tax and obligations on the deemed disposition or sale of the TCP. It can get even more complicated based on what the asset base of the shares of Titorenko are. In certain instances, that can add a complexity that we will not get into in this presentation. In this case, the US beneficiary likely has an obligation to file an application for a compliance certificate on a timely basis, and this is effectively a withholding certificate to reduce their withholding tax from a percentage on the gross value of the capital interest to the estimated gain on this interest. This is a fairly complex area of Canadian tax law, and as a general rule, as soon as an executor or beneficiary is aware of this situation, they should immediately consult a Canadian tax advisor for precise advice on the applicable Canadian tax and tax reporting obligations that may apply, whether it be at the estate level or the level of the non-resident beneficiary. So we'll now discuss the US income tax implications of this transfer of shares.
So from a US income tax perspective, there is no US income tax event from moving from an indirect beneficial ownership to a direct ownership. Assuming that the distribution of shares of Canco triggered Canadian tax, as Sergei explained, the US beneficiary could report this tax as a foreign tax credit and carry it forward to future use if not used in the current year. From a US income tax perspective, the US beneficiary is acquiring the shares of the PFIC with a cost basis equal to the fair market value at the time of that death. As the shares of Canco are now actually distributed to the US beneficiary, the US beneficiary has to report this distribution from that estate in Form 3520. Failure to file this form, as Sergei has highlighted already, there is a potential penalty, a significant penalty for failure to file.
So we're going to conclude our presentation with some key takeaways based on whether you're the executor of a Canadian estate that has non-resident beneficiaries, or if you're a US beneficiary of a Canadian estate. So from the perspective of the executors, one of the first questions you should ask yourself if you're the executor of a Canadian estate is, are any of the beneficiaries of the estate non-residents under Canadian income tax rules? As we have seen, distributions made to non-resident beneficiaries may attract a set of compliance obligations and tax for the estate. In addition, if any of the executors or beneficiaries of the estate are non-residents under Canadian income tax rules, they should first consult a Canadian tax advisor on what Canadian tax and tax reporting or filing obligations apply to the estate with respect to those executors or beneficiaries. One of the points that sometimes is missed is that the residency of the executors can have a determinant effect on how the estate is treated under Canadian income tax rules. It's administered by primarily non-resident executors. That can pose a Canadian tax issue, and on top of that, can also pose legal issues. From an estate administration perspective, a Canadian lawyer's advice should be sought on the ramifications of the estate having either non-resident executors or non-resident beneficiaries. For example, if there's a non-resident executor, there may be an obligation in the province where the estate is administered to provide a form of security or bond to secure execution of or fulfillment of the executor's duties. In addition, Canadian banks or financial institutions in the past have shown a reluctance to take instructions from any non-resident executor, even if that executor happens to be a Canadian citizen. The fact that they're not a Canadian tax resident or don't have a Canadian address has been an issue in the past. And in addition, when there's a non-resident beneficiary, again, there's the withholding obligations applicable to the estate may trigger a legal obligation for the executors. And if that withholding obligation is not complied with, then the executors could be potentially on the hook for failure to comply. Now, from the perspective of a US beneficiary of a Canadian estate, well, first you should obviously consult a Canadian tax advisor to understand if you have any Canadian tax or tax reporting obligations with respect to your status as a non-resident beneficiary. As we've seen, receiving capital distributions from a Canadian estate may require you to apply for a compliance or withholding certificate from the CRA to report a disposition of the property and remit tax on the capital interest in the estate. In addition, you should also consult a US tax advisor, because as a US taxpayer, you're subject to US income tax and tax reporting obligations on your worldwide income and assets, and these include substantial disclosure obligations and potential tax liability on any distribution you receive directly or indirectly from a foreign estate or a foreign corporation or even a foreign trust. And if you fail to file any of these disclosure obligations, or several of them, the penalties are significant and can easily pile up. So we trust that this presentation has given you an understanding and appreciation for the complexities of Canadian estates that have US resident beneficiaries, and also, especially when that estate happens to hold shares of a Canadian private corporation, how quickly the administration of the estate can become complicated, and the significant US and Canadian tax and tax reporting obligations that may apply to a USU as a US resident beneficiary of a foreign estate. Thank you. It has been a pleasure discussing this topic with you.
Great. Thank you so much to Beatriz and Sergei. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Beatriz, Sergei, or myself where appropriate. And I'll be sure to include their contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my spring webinar series continues on Thursday, May 25th on Private Foundations, the 5 Deadly Sins or Excise Taxes, featuring Andrew Katzenberg, partner at Aaron Schiff, LL.B. I'll send out an invitation to this and all of my upcoming webinars after the program. Second, if you or a colleague would like to be kept abreast of my latest articles, webinars, and all the other work I put out, you can sign up for my free monthly newsletter. Simply email me with the word newsletter in the subject line. You can also follow my work on Twitter, YouTube, and Instagram at Shenkman on Money. And finally, you can listen to my new podcast called Shenkman on Money, which is available on Apple, Spotify, or wherever you get your podcasts. Finally, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. And I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.